Okay, so before you drop a price on a house right now, I have some really good information I want to share with you, and it's relative to seller buy downs. I know we're not seeing a lot of those in Massachusetts because it just hasn't been that, competitive from a seller standpoint. And what I mean by competitive from a seller standpoint, sellers haven't had to do much to really get buyers, interested in trying to buy their house, right? The demand's been there. I'm seeing pockets of areas where houses are sitting a little bit longer. It seems like a little bit of a tale of two market where one house in one area is still going fast and furious over asking. And then you have another house that's seemingly well priced and nice and in a good spot that just isn't selling for some reason or another, right? So we're just starting to see it. I'm hearing that feedback from realtors. So what I'm suggesting to my realtor partners right now is to have a really thorough conversation with your sellers about the marketing strategy relative to price and relative to who's walking in the door buying the house, right? If you're in Massachusetts and if you have a listing that's between, I'd say 500,000 and $1 million, and it's a single family home, there's a good chance whoever's buying it is getting a mortgage. It doesn't mean that it's not all mortgages out there, but that's probably that sweet spot, right? And that's probably that sweet spot that whoever's getting a mortgage, the payment for them is more critical than the purchase price, right? Even if they might not understand that dynamic. And that's why I want to send this video out, because if you need the information to help sell a seller on a seller credit and then also sell buyers as they come in the door on a seller credit and the impact, that's what I'm here for. So I got a quick scenario that I'm gonna share my screen in a little bit to go into the impact of a seller credit and a buy down permanently, because right now I know from speaking with clients, a temporary buy down doesn't move the boat, move the needle, and they're not a big fan of adjustable rate mortgages, right? I know that there's an uptick in adjustable rate mortgages. I think people are doing that out of desperation to try to grab as much budget friendly mortgage payment as they possibly can, but they're really only doing it because the market's telling them, hey, don't worry about it. Remember when rates were just really low? We're going to be low again, refinance later. I don't think they're getting into it with the mindset of, hey, this is fine. It's going to be okay. I'm going to pay the house off in 5 years. I think a lot of people getting an adjustable are doing it just from the payment standpoint. And the seller credit with the 30-year fixed permanent buy down, they'd much rather have that than the adjustable rate mortgage with the risk that, hey, what if rates don't come down? Which is a possibility. They might not get below 5.5% if we have a strong economy and we don't need to have low interest rates, right? We won't see low interest rates if we don't need them. So from that standpoint, let's run the quick numbers. I'm going to share my screen now. Let's go over here. Share. Okay. So here's what we got going on. So the scenario I'm looking at is a price drop compared to a buy down, right? Which option helps buyers more? Scenario A, no incentive. So let's say the buyer's coming in the door, they're getting a $750,000 house. Let's say their interest rate 6.5 with 10% down, loan amount of 675. Just the principal and interest alone right there is 4266, right? Scenario B, $25,000 price drop, because maybe you've sat down with your seller and you're like, hey, we got to go down a little bit in price. You have it sold in a couple weeks, and we've really got to get these buyers in the door. Let's move the price, right? Let's go down 25,000. What that does to the same buyer in a vacuum, so still a 10% down buyer, 6.5% interest rate, because they're not moving the needle too much on the rate, their payment's going to go down to 4126. They're saving $140 a month. Not bad, but in the grand scheme of things, that doesn't feel like a big value add to a buyer right now. It just doesn't, right? It's good, but it's not really moving the needle. Now, instead, your sellers stay put at 750, but they offer a $20,000 credit, and you offer this scenario in the marketing to buyers coming in the door, and it's the permanent rate buy down. Right now, 20 grand is probably going to get the typical buyer somewhere in the mid fives on a 30-year fixed. That same scenario, again, paying 750, putting 10% down, loan amount of 675. The seller put in 20,000. That's how you incentivize buyers in the door. Same thing as a price cut. You're trying to incentivize buyers in the door. That payment now is $38.87. It's a swing of $379 a month compared to no incentive, and it's $239 a month cheaper than the price drop, right? It's almost a no-brainer, and it actually saves your seller $5,000. Not monumental, but it's just a little bit better, right? And I'd even say what you could do in these scenarios, because I know the price drop is going to get you a benefit in terms of MLS movement and how people search online and all that fun stuff. And the reason why I did 20,000 instead of 25 to make it apples to apples is because maybe you couple it with the $5,000 price drop, so you get that movement. And then when you do that, that's when you go in and change the description as well, saying, hey, seller's also willing to offer a $20,000 seller credit. And we run the numbers and you provide the marketing to show, hey, if you're a typical buyer with a 740 FICO score, 10% down, getting a conventional loan with interest rates here, here's what the 20,000 is going to do for you. And then that way you get the movement in MLS, you get that searchability of a price drop. It's the same net loss to the seller, but it's the same initiative of we are changing the price or the mechanism to buy this house to market it better, right? This is really prevalent in the rest of the country where there's a lot of building, right? So areas like Texas, Florida, Arizona, areas where there's still the big four builders of the country building big subdivisions. And the big four builders are KB, Pulte, Lennar, and Toll Brothers, right? Those are really the big four builders in the country that build the majority of new construction homes across the country, right? They all offer incentives to drive down the interest rate, and their agents are all trained up on how to sell that as a benefit, because the way they sell it as a benefit, because there's one more extra thing here that you can go over with buyers when they come in the door, and I can run it for you on your specific listings as well, is the price drop that would need to happen to create the same payment outcome. And it's usually substantial, right? In this scenario, just from my mental math of doing this so many times, these people, these sellers of this hypothetical $750,000 house, if they wanted to create a principal and interest payment of $38.87 for that same buyer, the 10% down buyer with a 6.5% interest rate, regular market rate right now, they probably have to reduce the price to under $700,000 to create the same principal and interest payment. And so when you have that info, as you're fielding phone calls or as you're calling back out to anyone that's come to an open house in the past few weeks, you're going, hey, you can now buy a $750,000 house with the same budget as a $690,000 house. Which one do you want more? And that's just what the new construction salespeople do, right? They have the incentive built in, they got the mortgage company lined up with the marketing. And then as people are coming in the door, they say, hey, what's better for you? Do you want the $750,000 house with this payment because we've drove the interest rate down for you and it's all built in? Or do you want the $680,000 house that you might not get as much house, but it's the same payment? It's this relatively the same down payment, same payment, because the interest rate is it's why we're having a logjam in Massachusetts with inventory, right? If they survey sellers and buyers, everyone's waiting for 5% interest rates, and we might not get them in the next year. Maybe we do, but when I read the tea leaves of the interest rate market and how the flow of money goes, it's going to be really hard for rates to be below 5.5 or even around 5.5, just based on the flow of money, right? So from that standpoint, you can get them an interest rate in the mid fives, but you got to pay for it. And if sellers are already starting to reduce price, you might as well just get the buyers a better interest rate and market it that way rather than trying to chase the market down with price drops. Because if buyers are waiting for their payment to be in a better spot, you've got to really go down in price a lot to make that work. So, and it can create some stability in the market of, keeping prices good, because we really don't want prices to slide too much, because that's just going to be a whole another problem that we have, right? So from that standpoint, again, I think don't have a conversation with sellers about reducing price until you have this information. If you want to dive into specifics with me, more than happy to do it. And I think this is all very relative information to today's market, and I hope it helps. Talk to you soon.